Hello, ladies and gentlemen. This is your teacher Usman Ali, and the video is for the solution of the exercise 4.8. Now we're gonna learn two irregular item adjustments here. The first one is the unusual or infrequent gain and losses, and the next is we're gonna learn the extraordinary item adjustment as well. So if you see in the numerical, first we have information on net sales 1.2 million. Okay, we need that. Cost of goods sold, good, we need it. Selling expense 65,000, yes. Administrative expenses 48,000. Dividend revenue, we need it, yes. Interest revenue, of course, we're gonna need it as well. Then the next information that we have is write off of inventory due to obsolescence. So we got a write off of inventory. Some of our inventory worth $80,000 got finished due to its obsolescence. Okay, so this is a loss for us. We need this loss because this is an unusual or infrequent item. Then depreciation expense omitted by accident in 2008. So yes, this is an errors and omission irregular item. We need this not to prepare the income statement but to have a retained earning statement. And then we have a casualty loss, which is an extraordinary item. Before tax is $50,000. We need it. Cash dividend paid, retained earning, and effective rate 34%. So actually we need all of the information because we are supposed to prepare two things. We are supposed to prepare the multi-step income statement and retained earning statement. So some of the information we need it for retained earning, and some of the information we have it is for the multi-step income statement actually. Okay, so let's start preparing the multi-step income statement first. The name of the company, income statement, and for the year 2010 it's written there. Then we will start with the net sales figure. As always, sales comes first, which is 12 lakh or $1.2 million actually. And from net sales we are supposed to subtract the cost of goods sold. The cost of goods sold is $7,80,000. Let me show you. Okay, this is the net sales figure and the cost of goods sold figure. Okay, remember the selling expense and admin expenses as well. Keep it in your mind. Okay, I will directly write it here. So once I subtract cost of goods sold from my sales, so I will get gross profit, which is $4,20,000. This is my gross profit. After the gross profit, we're gonna subtract all the operating expenses related to the organization. So earlier I showed you that there are two operating expenses actually incurred by the organization. One are related to sales, so we can call them as sales expenses, which was, if you remember, $65,000. And the second expenses, group of expenses that we have are related to administration side, which was, if you remember, $48,000. And that's it. We did not had further expenses actually. So what we're gonna do is that we're gonna plus both of them. This will become $1,13,000. So this is our total of the operating expenses. So 4,20,000 minus 1,13,000, we get an EBIT of $3,07,000. This is our EBIT, or you can also call it as operating income. From this, then we have, when we plus or minus the others, which represents the non-operating revenues and expenses, ladies and gentlemen. So if you see here, we got dividend revenue and we got interest revenue. Both of these revenues are non-operating revenues. So I will write it here. First, plus the dividend revenue, okay, which is $20,000 that will be added. Then the next revenue we have is interest revenue, which is around $7,000. And ladies and gentlemen, if you remember, this is the place which is like below EBIT and above EBT. If you remember my video on the adjustments of irregular item, this was the place where we used to adjust two irregular items. One was special, unusual or infrequent gain and losses, and the second was in change in estimate. So let's see if we have anything related to that. Okay, so net sales are done, cost of goods sold is done, selling expense is done, admin expenses, dividend revenue, interest revenues are also done. Let's start from here. Write off of inventory due to obsolescence. Okay, yes, this is an unusual or infrequent item based on the basic discussion of our PPT, if you remember. So write off of the inventory due to obsolescence, $80,000. I'm gonna adjust it here. This is a irregular item. Okay, so I will write it here, minus write off of inventory due to obsolescence. So I will write in short, and the worth of that was, or the value was, $80,000 minus. So if you remember pre-tax from the previous video, we don't need to subtract any tax right now from here. Okay, so this is done. Then let's go to depreciation. Depreciation is something which is related to retained earnings statement here because it is omitted, errors and omissions. That's why. Casualty loss is an extraordinary item. We need it here, but at the end of the income statement, cash dividend declared. Cash dividend, if you remember the discussion on the retained earnings, so it is related to retained earning statement. Retained earning, again, this by the name itself explains I belongs to like retained earning statement, and the effective tax rate is 34%, which means that no more further adjustments are required here. I will conclude it here. When I conclude it here, so according to the procedure, I'm gonna plus these two with the EBIT and minus 80,000 from the EBIT. So actually I will get a value of $254,000. This is the value that I will actually get. From this value, then I will subtract the tax expenses. Now, if you remember, our tax expenses are 34%. So the 34% of the taxable income. So if I multiply 34% with $254,000, it will become $86,360 minus. So let's subtract it. When I subtract it, it becomes $167,640. Now normally we call this as a net income, but as if you see, we have extraordinary item present here. So I cannot call this value as net income. I will call it as income before extraordinary item adjustment. So it means that this is the income which is not adjusted to the extraordinary item. So then I will go for extraordinary item adjustment. It's loss actually, okay, $50,000 before tax. So if it is a loss, I'm going to write here minus, and then I will write here loss from or due to extraordinary item, ordinary item. How much is the amount of loss? $50,000. I will write that in the sub column actually, and then I will do the tax adjustment. If you remember from the video of the adjustment of irregular items, so 34% of $50,000, this is $17,000 actually. I will subtract 17 from $50,000. This would be 33,000, and as it is lost, I'm going to subtract that. So 1,67,640 minus 33,000, the remainder would be called as $1,34,640. Now we are good to call it as net income because there is no more other adjustment related to income statement remaining. Okay, so this was the part A of the numerical. Let's go to the part B. Let's prepare the retained earnings statement for the year 2010. And if you remember, I have written here RES, RES, RES. So these are actually the values which are related to the retained earnings statement. Okay, now if you remember again from our previous videos, this is the format of the retained earnings statement, which starts with the company name, the statement name, and for the year. And if you remember, every retained earnings statement starts with initially starts with the beginning retained inventory. So I will write here beginning, you can correct the spelling, beginning retained earning balance, okay, as on 1st January 2010, which was the start of the year. Okay, so to know it, I will go to the numerical data given here. Now if you see here, this is written here, retained earning at December 31st 2009, 9,80,000. So this was the last year of 2009. So whatever this amount is, this will be shifted to the 1st of January 10, because the ending of this year will become the beginning of the next year. So if it's written 31st December 2009, I'm going to take it as 1st January 2010 beginning, $9,80,000. You know, this is a very basic concept actually. And then if you remember from that basic understanding, so we do irregular item adjustments here after this balance. Okay, so let's see if we have any adjustments needed. Okay, so if you see here, depreciation expense omitted actually, so it means that this is an errors and omission irregular related item, depreciation expense. Accidentally in the previous year you were supposed to minus $40,000 depreciation expense, but you forgot to do it. So let's do it right now after 1 year actually. So as this is a depreciation expense, so that would be minus then. So it's like expense is minus. I will write there adjustment of depreciation expense from 2009, like year 2009. So what is the amount of omission? $40,000. So I will write here $40,000. Now $40,000, I have written it in the sub column because of the tax adjustment, and then I will do the tax adjustment of this. So if you remember, our tax percentage was 34% actually. So I will multiply 34% with $40,000. When I multiply this, it gives me a value of $13,600. Okay, so 40,000 minus 13,600, my net value would be $26,400 minus, because it's depreciation expense adjustment. So that's it, we are done with the adjustment. I will plus 9,80,000 with 26,400. So this becomes minus it, not plus it. It becomes 9,53,600. This would be called as, you can say, adjusted balance. Why I am calling it as adjusted balance? Because I just made an adjustment here. Adjusted balance of retained earning, but means as on 1st January 2010, means the start of the year, not end of the year. So what I will do, if this is the value at the start of the year, then during the year I did business and I had made some profits as well. So what I will do is that I will plus all the profit or the income that I had generated from my company actually. So if you remember, we did calculation of income and our income was 1,34,640 here. So I will write it here, $1,34,640. Now out of this income, it is possible that I may have paid dividend. If I am paying dividend, that will decrease the retained earning. Okay, that will means decrease the equity. So let's see if I have paid any dividend. Yes, cash dividend declared and paid $45,000. So I will write it here, dividend paid minus $45,000, and that's it. This is the coming in, this money went out, that was the previous balance. So 9,53,600 plus 134,640 minus 45,000, it becomes $1,043,240. actually we call this as ending retained earning balance. Okay, as on, and then the last year, the last date, 31st December 2010 actually. So that's the answer of the part B, and this was the answer of part A. Thank you very much. Stay safe.